Welcome back to The Explainer, where we break down the big topics using the data behind the headlines. Today, we are diving into tariffs. Now, I know, they sound like a pretty dry economic policy, but trust me, they have a direct impact on your wallet. And they might just be part of a really high-stakes global strategy. We're going to break down what they cost, who they affect, and the wild theory behind it all.
So let's just jump right in with the number, $1,800. So, what's that all about?
Well, according to the folks over at Yale's Budget Lab, that is the estimated price tag of new tariffs for the average American household every single year. So this isn't some abstract policy happening somewhere else. It's a real hit to your own budget.
Okay, so how does a policy like this actually, travel from a government office and a shipping port all the way to the price tag on something you buy at the store? Let's get into where these costs really come from.
Now, and the impact gets really specific really fast. We're talking about a price jump of nearly 30% in the short term for things like shoes and clothes. Even your car and your groceries get more expensive. These aren't some far-off luxury goods, right? This is the stuff we all buy all the time. And that is exactly how you get to that $1,800 number.
All right, so let's zoom out a bit. We've seen the impact on your wallet, but what about the entire U.S. economy? I mean, the whole stated goal of these policies was to boost American industry, to fix our trade balance. The big question is, did any of that actually work?
Yeah, that really is the multi-trillion-dollar question, isn't it? The goals were super clear. Bring manufacturing back and get that trade deficit down. So what does the data actually tell us?
Well, the research is pretty clear on this one. The tariffs didn't just miss the mark. They often did the exact opposite of what they were supposed to do. Instead of a big manufacturing boom, we actually saw job losses in some areas because materials got more expensive. That trade deficit we were trying to fix, it actually got bigger. And our reliance on China didn't go away. Goods just started taking a detour through places like Mexico and Vietnam.
And this chart, wow, it shows a classic economic trade-off, and it's not a good one. You see that little bump for manufacturing? A modest 2.5% gain. But look at what happened to construction. It got hammered, dropping almost 4%. So when you do the math, the net result is that the overall economy actually took a hit.
Right, and none of this happens in a vacuum, of course. When one country puts up a tariff, it sends these shock waves all around the world. It creates this global shuffle with a whole new set of winners and losers. Let's take a look at how that actually works.
Think of it like this. When the usual ways of doing business get blown up, yeah, some countries get hurt pretty badly. Their biggest customers suddenly close the door. But for other countries, it's a huge opportunity. They can swoop in and fill that gap. Economists have a name for this. It's called trade diversion.
And this UNIDO analysis gives us the perfect real-world example. Just look at the difference between Cambodia and Kenya. Cambodia got slammed with a massive 48% tariff, and you can see their exports and overall welfare just tanked. But then there's Kenya. They faced a way smaller tariff, only 10%, and they actually came out ahead. How on earth does that happen?
It really all boils down to two things: exposure and flexibility. Cambodia was all in on the U.S. market, especially in clothing, which was a main target of the tariffs. They were just totally exposed. Kenya, on the other hand, had a much more diverse economy. They weren't so dependent on the U.S., so they could pivot and start picking up all that business that Cambodia was suddenly losing.
Okay, so this is where things get really interesting, because it leads us to this massive question. What if these tariffs aren't really about trade at all? What if they're just a tool for something way, way bigger?
So, there's this theory floating around out there. It's speculative, for sure, but it's absolutely fascinating. It suggests that all this economic pain we've been talking about, it's not a bug, it's a feature. It's a deliberate part of a much bigger and honestly much riskier global game.
And the heart of this whole theory revolves around the US dollar. Now, for decades, the dollar has been super strong, which sounds great, right? But a strong dollar actually makes American-made stuff more expensive for the rest of the world, and it makes foreign imports super cheap for us. That's not great for US industry. According to the IMF, the dollar might be overvalued by a mind-boggling 74%.
And this has led to this really controversial idea, which some have nicknamed the Mar-a-Lago Accord. The theory is that tariffs are basically being used as a weapon, as leverage to force our allies into a new deal, a deal that would intentionally devalue the US dollar and totally reshape global trade.
So how would this work? Well, it's a pretty audacious three-step plan. Step 1, you impose tariffs and cause a lot of economic pain. Step 2, you offer them a way out.
They would have to swap their U.S. debt for these brand new, super long-term, like 100-year bonds that pay zero interest. And step 3, why would they do that? In return for giving the U.S. this huge interest-free loan, they get the tariffs removed and this is the kicker, they get continued U.S. military protection.
Look, this kind of hardball protectionism, it's not new. We've actually seen this movie before. And history gives us a very powerful and frankly a pretty terrifying warning about where this kind of thing can lead.
Let's go back almost 100 years to the Hawley-Smoot Tariff Act. The goal then was pretty much the same: protect American jobs. But the result? It was an absolute disaster. It kicked off a global trade war. As every country threw up their own tariffs in retaliation, global trade just collapsed. It fell by over 60%, and it dragged the whole world even deeper into the Great Depression.
You see, for decades, the U.S. has had this incredible advantage because the dollar is the world's main currency. Everyone needs it, which means America can borrow money way more cheaply than anyone else. The Council on Foreign Relations calls it an exorbitant privilege, and it's been the bedrock of American economic power since World War II.
And that brings us to the final and most provocative question of all. The policies we're seeing today, from the tariffs that cost you money to these wild theories about a Mar-a-Lago Accord, they force us to ask, what happens when the world's biggest economy decides that its greatest exorbitant privilege has suddenly become an unbearable burden? What happens when they decide to just throw it all away?